I've built NVIDIA from a 3-person startup into one of the most valuable companies on earth. I've seen the dot-com bubble burst. I've navigated the 2008 financial crisis. I've watched crypto winters wipe out trillions. And right now, in 2025, I'm seeing patterns that keep me up at night. Not because I'm worried about NVIDIA, we'll be fine, but because I'm seeing the exact same warning signs that appeared before every major market crash in history. And most people have no idea what's coming. Let me be very direct with you. The AI boom that's making tech investors rich right now looks almost identical to the internet boom of 1999. The speculation in AI stocks mirrors the tulip mania of 1634. The leverage in the system reminds me of 1929, and the complexity of modern financial instruments is worse than what caused Black Monday in 1987 or the mortgage crisis in 2008. I'm not a doom and gloom person. I'm an optimist. I believe in technology. I believe AI will transform civilization, but I also believe in learning from history. And history is very clear about what happens before market crashes. There are patterns, there are warning signs, and if you know what to look for, you can protect yourself. Today, I'm going to share with you the 4 patterns that appear before every major market crash. These aren't theories. These are historical facts that have repeated themselves for 400 years. And more importantly, I'm going to show you how these patterns are showing up right now in the AI revolution, in the stock market, in the economy. Because understanding these patterns isn't just about protecting your wealth. It's about surviving what's coming. Let me start with the oldest market crash we have good records of, not because it's ancient history, but because it reveals something profound about human psychology that hasn't changed in 4 centuries. We're going back to 1634 to the Netherlands during what's called the Dutch Golden Age. The Netherlands had just become independent from Spain. They'd launched the Dutch East India Company, which was the first modern corporation. They'd invented the world's first stock exchange in Amsterdam. They were the dominant global superpower of their time, kind of like America after World War II. Money was flooding into the country, innovation was everywhere, and everyone felt like they were living in a new era where the old rules didn't apply anymore. Sound familiar? It should, because that's exactly how people feel today about AI. In the Netherlands, the new hot investment was tulip bulbs. These flowers had been imported from the Ottoman Empire, and they became incredibly fashionable among the wealthy. At first, they were just expensive status symbols. Wealthy merchants would display rare tulips to show off their success. One historian estimated that a pound of tulip bulbs sold for about a month's salary. That would be like paying $3,300 for flowers today. But then something changed. The speculation started. People began buying tulips not to enjoy them, but to flip them for profit. Prices kept rising. More and more people jumped into the market, convinced they'd found an easy way to get rich. The Dutch had invented futures contracts, where you could lock in a price today for tulips you'd receive next season. And these contracts themselves became tradable assets. This is where the first pattern appears. Investor overconfidence and rampant speculation. People were no longer asking what tulips were actually worth. They were asking what price they could sell them for tomorrow. The fundamentals didn't matter. Only the momentum mattered. At the peak of tulip mania, some bulbs sold for the equivalent of 5 years of average salary. That's like paying $200,000 for flowers today. The same amount you'd spend on a house. People were taking out loans to buy tulip contracts. They were mortgaging their property. They were betting their entire future on tulips because they were absolutely certain prices would keep rising. And here's the thing that should scare you. These weren't stupid people. They had rational arguments for why tulips were valuable. Tulips were rare, they were beautiful, they were a status symbol. You could grow more tulips from your bulbs, so you were buying a productive asset. Every criticism was dismissed with some version of, "This time is different." Does any of this sound familiar? Replace tulips with AI stocks. Replace Dutch merchants with Silicon Valley investors. Replace futures contracts with options and derivatives. The psychology is identical. The tulip bubble eventually burst. Of course it did. All bubbles burst. And when it happened, it wasn't just tulip prices that collapsed. The entire futures market crashed. Land values plummeted because tulip fields became worthless. Banks failed because they loaned money against tulip collateral. The whole Dutch economy suffered. But here's the lesson that matters. Before the crash, everyone thought they were being rational. They had arguments, they had data, they believed this time is different. The speculation didn't feel like speculation. It felt like smart investing. Now let's jump forward almost 300 years to 1929 and the crash that led to the Great Depression, because this reveals the second pattern that appears before every crash. And is particularly relevant to what I'm seeing in the AI industry right now. The 1920s in America were remarkable. The Industrial Revolution had created more wealth than any previous period in history. Cars, electricity, radio, these technologies were transforming daily life. The stock market was soaring. Regular people were becoming millionaires. It felt like a new era of endless prosperity. Sound familiar again? Because that's exactly how people talk about AI today. In the 20s, a new type of investment vehicle had been invented called leveraged investment trusts. These weren't normal investment funds. They used debt on top of investor money to make bigger bets. They could magnify gains. Of course, they also magnified losses. But why worry about losses when the market only goes up? This leverage wasn't limited to professionals. Regular people could buy stocks on margin, borrowing money to amplify their returns. And why not? Everyone knew the stock market always went up. Sure, there had been crashes before, like in 1907, but this was the modern era, the 1920s. They had technology like telegraphs and telephones. They had sophisticated financial models. The old rules didn't apply anymore. I want you to notice something. That phrase keeps appearing. This time is different. The old rules don't apply. We're in a new era. Every bubble uses the same language. Every speculator convinces themselves they're not speculating. In the 1920s, the government wasn't concerned about the leverage building up in the system. This was the laissez-faire era. President Calvin Coolidge said, the chief business of the American people is business. Regulation was seen as stifling innovation. The economy was booming. Why mess with success? This is the second pattern. Regulatory shortcomings. Either regulators act too late and too hard, triggering a crash by suddenly tightening, or they don't act at all, allowing instability to build until the system collapses under its own weight. In 1929, it was the latter. The government barely regulated the financial markets. Leverage investment trusts were trading at double the value of the stocks they actually owned. It would be like buying a hedge fund today that's worth twice as much as all its investments combined. The goal wasn't generating returns. The goal was attracting more investors to inflate valuations. Everyone was in the market. Shoe shiners were giving stock tips. Little girls were mailing money to buy shares. One writer declared they'd entered a new era with no more boom and bust, just endless upside. And then it all collapsed. The stock market fell 89% over the following years. It was the biggest crash in history. What followed was the Great Depression. 1 in 4 Americans lost their jobs. Families lost everything. Banks failed. The economy didn't fully recover until World War II. The regulatory response was dramatic. The Banking Act of 1933, also called Glass-Steagall, separated commercial banking from investment banking. It created FDIC insurance so people couldn't lose their deposits because a bank made bad bets. The government learned that regulation isn't about stifling growth. It's about preventing instability from building up until it destroys the entire system. Now, here's why I'm bringing this up in the context of AI. The AI industry right now is experiencing explosive growth with minimal regulation. That's been great for innovation. It's been great for NVIDIA. But it's also creating the exact conditions that led to past crashes. Everyone is pouring money into AI startups. Valuations have disconnected from fundamentals. Companies with minimal revenue are worth billions because they have AI in their name. This is exactly what happened with internet stocks in 1999 and mortgage securities in 2006. Let me move to the third pattern. This one is particularly important because it's happening right now in multiple areas of the market. The pattern is poorly understood innovation, new financial products or technologies that even the experts don't fully comprehend. The classic example is Black Monday in October of 1987, which remains the worst single-day drop in stock market history. To understand what happened, you need to know about an innovation called portfolio insurance. In the 1980s, Wall Street was transforming. Computers were becoming central to trading. Quants were using mathematical models to make investment decisions. And two professors, Black and Scholes, had written a paper that inspired the idea of portfolio insurance. The concept was simple. If the market dropped, your computer would automatically place small trades betting against the stock. If the stock kept falling, those trades would offset your losses. It was like a seatbelt for your investments. By 1987, over $80 billion was being managed using these portfolio insurance models. But here's the problem. The innovation was so complex that even the banks using it didn't fully understand the systemic risk. What happens if everyone's computer starts selling at the same time? What if the selling triggers more selling? What if the mathematical models break down during extreme volatility? No one asked these questions. The models said it would work, and that was enough. This is the danger of poorly understood innovation. It feels safe because it's sophisticated. It feels smart because experts are involved. But complexity often masks risk. Portfolio insurance by itself wouldn't have crashed the market, but it collided with other patterns. The 1980s had rampant speculation in leveraged buyouts. Investors were piling into stocks, hoping for takeover offers. The market had become frothy, and there were regulatory shortcomings. Nobody understood how portfolio insurance could backfire. In August of 1987, the market started declining, slowly at first. But the computers were watching. They started triggering sell orders exactly as programmed. The problem was everyone's computers triggered sell orders at once. The selling accelerated. The market went into free fall. At one point, there were 500,000 sell orders for a single stock with no buyers at any price. After the smoke cleared, Black Monday was the worst single-day drop ever. All three patterns collided: investor overconfidence, regulatory shortcomings, and a poorly understood innovation that seemed brilliant until it wasn't. Now, let me connect this to today. The innovation that concerns me most is AI itself. Not the technology, which I believe in deeply, but the way AI is being deployed in financial markets, high-frequency trading algorithms powered by AI, risk management systems using machine learning, derivative products based on AI company valuations. Do we fully understand how these systems will behave during a crash? Do we know what happens when AI trading algorithms start feeding off each other during a panic? I don't think we do, and that should concern everyone. Let's move to the fourth and final pattern, the buildup of debt. This is what amplifies every crash and turns market corrections into systemic crises. The best example is 2008, which I remember vividly because NVIDIA nearly didn't survive it. The 2008 crash started in housing. After the dot-com bubble burst in 2000, investors wanted safer assets. Housing seemed perfect. Real estate always goes up, right? They're not making any more land. Banks were happy to provide mortgages to anyone with a pulse. They'd then package these mortgages into complex securities and sell them to investors without disclosing how risky the underlying loans were. This is where all four patterns converged. Investor overconfidence. People believed housing prices couldn't fall. Regulatory shortcomings. The government encouraged homeownership without ensuring loan quality. Clinton pushed homeownership hard. The Federal Reserve, under Bush, kept rates low, encouraging cheap borrowing. Poorly understood innovation, mortgage-backed securities, and collateralized debt obligations were so complex that even the banks creating them didn't understand the risks. And massive debt buildup. Household debt grew rapidly. People bought the biggest houses they could get loans for, regardless of whether they could afford them. The debt was the accelerant that turned a housing correction into a global financial crisis. When housing prices finally fell, people couldn't pay their mortgages. The securities built from those mortgages collapsed. Banks holding those securities failed. Lehman Brothers, operating for over 150 years, went bankrupt in September of 2008. Unemployment surged past 6%. The stock market crashed. The global economy froze. I remember those days at NVIDIA. Our stock fell from $30 to under $6. We had to make brutal decisions about layoffs and spending cuts. We weren't sure if we'd survive. The crash didn't just hurt speculators on Wall Street. It destroyed lives. Neighborhoods never recovered. People lost their homes, their jobs, their savings. The lesson from 2008 is that debt transforms market corrections into catastrophes. Leverage means small drops become massive losses. When prices fall, leveraged investors are forced to sell, which drives prices lower, which forces more selling. It's a death spiral. Now, let me tell you what I see today that keeps me up at night. All four patterns are present simultaneously. That's rare. Usually you see one or two patterns, and that's concerning enough. But right now, in early 2025, all four patterns are flashing red. Let's start with investor overconfidence and speculation. Look at AI stocks. Companies that just added AI to their description saw their valuations double. Startups with no revenue are raising hundreds of millions. NVIDIA's market cap went from $300 billion to over $3 trillion in less than 3 years. I'm not saying NVIDIA is overvalued. I think our business fundamentals justify our valuation. But the speed of that rise, the fervor around anything AI related, the certainty that AI is a guaranteed gold mine, all of that mirrors past bubbles. People are buying AI stocks not because they understand the technology or the business models. They're buying because they're convinced AI stocks only go up. They're buying because they don't want to miss out. They're buying to flip to a greater fool. That's speculation, not investing. I hear the same language I heard in 1999 about internet stocks. This time is different. We're in a new era. AI will change everything, so traditional valuations don't matter. These statements might even be true. AI probably will change everything, but that doesn't mean current stock prices are justified. The internet did change everything. But most internet stocks from 1999 went to zero. Amazon survived, but its stock fell 90% from peak to trough. The regulatory shortcomings are also obvious. AI is developing faster than regulation can keep up. There are essentially no guardrails on AI development. Companies are deploying AI systems without fully understanding their capabilities or limitations. Governments are talking about AI regulation, but nothing substantive has been implemented. In financial markets, the situation is even worse. The leverage in the system is enormous. Margin debt is at historic highs. Options trading has exploded. Retail investors are using leverage they don't understand. Everyone assumes the Federal Reserve will bail out the market if things go wrong. This moral hazard encourages more risk-taking. The poorly understood innovations are everywhere. AI is being integrated into trading systems, risk management, financial forecasting. But do we understand how these AI systems will behave during a crisis? When markets are falling fast, when correlations break down, when historical patterns stop working, how will AI trading algorithms respond? Will they amplify the panic or dampen it? I don't know the answer. And that uncertainty is itself a risk. In 1987, portfolio insurance seemed like a brilliant innovation until it triggered a crash. Are we setting ourselves up for a similar surprise? And finally, the debt. This is what worries me most. Debt levels are higher now than they were before 2008. Government debt, corporate debt, household debt, all at or near record levels. The US federal government has over $34 trillion in debt. Corporate debt has exploded as companies borrowed at low rates. Consumers are carrying record credit card balances. When interest rates were near zero, this debt was manageable. But rates have gone from 0 to over 5% in less than 2 years. That's one of the fastest tightening cycles in history. And this is stressing the entire system. Companies that borrow cheap money are struggling to refinance. Commercial real estate is collapsing as loans come due at much higher rates. Regional banks are sitting on huge unrealized losses. This debt overhang means the system is fragile. A small shock could trigger cascading failures. And there are plenty of potential shocks: geopolitical tensions, a recession, an unexpected crisis somewhere in the world. Any of these could be the catalyst that starts the cascade. Now, let me be clear about something. I can't predict when a crash will happen. Nobody can. Markets can stay irrational longer than you can stay solvent, as Keynes said. The patterns I've described could persist for months or even years before anything breaks. But I can tell you with confidence that these patterns always, eventually, lead to crashes. The only questions are when and how severe, and the fact that all four patterns are present simultaneously suggests that when the crash comes, it will be significant. So what should you do with this information? Let me share how I think about risk management, both at NVIDIA and personally. First, don't try to time the market. Knowing a crash is likely doesn't tell you when it will happen. If you sell everything and the market keeps rising for another year, you've cost yourself a lot of money. And if you're wrong about the crash, you've made an expensive mistake. Second, understand what you own. If you're invested in AI stocks or any other sector, do you understand the business? Do you know how it makes money? Could you explain the investment thesis to someone else? If not, you might be speculating rather than investing. At NVIDIA, I understand our business deeply because I've built it. I know why we're valuable. I know our competitive advantages. I know our risks. That knowledge gives me confidence even during market volatility. So if you don't have that understanding of your investments, you're vulnerable during crashes because you don't know if you should hold or sell. Third, reduce leverage. This is critical. If you're buying stocks on margin or using options or any form of borrowed money to invest, you're taking enormous risk. When the market crashes, leverage positions get liquidated first, you can lose everything even if you're eventually proven right about the investment. I never use leverage for personal investments. NVIDIA uses debt strategically for specific business purposes, but we maintain a strong balance sheet. In 2008, companies with too much debt went bankrupt, even if their core businesses were sound. Don't let leverage destroy you. Fourth, diversify intelligently. Don't put all your money in one sector, even if that sector seems like the future. Yes, AI is transformative, but that doesn't mean every AI stock will succeed. Most will fail. Even in a transformative industry, the majority of companies don't survive. Diversification isn't just about owning different stocks. It's about owning different types of assets: stocks, bonds, real estate, commodities. Different assets perform differently during crashes. Stocks might fall, but bonds might rise. Real estate might hold value, even if the stock market crashes. By spreading your investments across asset classes, you reduce the impact of any single market crash. Fifth, keep some cash. I know this seems counterintuitive when inflation is running at 5 or 6%, but cash gives you optionality. When crashes happen, assets go on sale. If you have cash, you can buy quality assets at distressed prices. This is when generational wealth is built. Warren Buffett is sitting on over $300 billion in cash right now. He's not doing that because he's lost his edge. He's doing it because valuations are high and he's waiting for opportunities. When the crash comes, he'll have the resources to buy when everyone else is forced to sell. I'm not suggesting you hold all cash, but having some dry powder means you can act when opportunities appear, and opportunities always appear during crashes. Sixth, focus on quality. In uncertain times, quality matters more than growth potential. Companies with strong balance sheets, consistent profitability, competitive advantages, and good management tend to survive crashes. Speculative companies with no profits and lots of debt tend to disappear. At NVIDIA, we've always focused on having a strong balance sheet even during rapid growth. We generate real cash flow. We have competitive advantages in GPU architecture and software ecosystems that protect us from competition. These fundamentals matter, especially during downturns. Seventh, think long-term. If you're investing for retirement 20 or 30 years from now, short-term crashes don't matter much. In fact, there are opportunities to buy at lower prices. The market has always recovered from crashes. Eventually, if you panic and sell during crashes, you lock in losses and miss the recovery. But thinking long-term only works if you can actually hold through a crash. That requires having no leverage, having an emergency fund so you don't need to sell, and having the emotional discipline to not panic. If you can't do those things, you're not really a long-term investor. Eighth, increase your earning power. This might seem unrelated to market crashes, but it's actually crucial. If you have high income, you can keep investing during crashes. You can take advantage of low prices. You can weather unemployment if you lose your job. At NVIDIA, we invest heavily in our people's skills because that's our competitive advantage. Individually, you should think the same way. Learn valuable skills. Make yourself indispensable. Build multiple income streams if possible. Your human capital is your most important asset, and it's also the only asset that can't be destroyed by a market crash. Ninth, pay attention to the patterns. You now know the 4 patterns that precede crashes. Watch for them. When you see investor overconfidence reaching extremes, that's a warning sign. When you see regulatory shortcomings allowing dangerous practices, that's a warning sign. When you see complex innovations that nobody fully understands, that's a warning sign. When you see debt building up to unsustainable levels, that's a warning sign. Uh, these patterns won't tell you exactly when a crash will happen, but they tell you when the risk is elevated. And when risk is elevated, you should be more conservative. Reduce leverage, take some profits, build your cash position. These actions might cost you some upside if the market keeps rising, but they'll protect you when the crash comes. 10th, and this is perhaps most important, control your emotions. Market crashes are emotional events. Fear takes over, people panic, they sell at the bottom, they make terrible decisions based on emotion rather than logic. I've been through multiple crashes, the dot-com crash, the 2008 financial crisis, the 2020 COVID crash. Every time, the fear is real. Every time, it feels like the world is ending. Every time, people are certain this crash is different and the market won't recover, but the market always recovers. Sometimes it takes years. The recovery from 2008 took about 5 years for the market to reach new highs. The recovery from the Great Depression took longer. But recovery always happens because the economy keeps growing over time. The investors who get rich from crashes are the ones who can control their fear, who can think clearly when everyone else is panicking, who can buy when everyone else is selling. This is easier said than done, but it's the most important skill in investing. Let me bring this back to NVIDIA and AI because I think our situation illustrates these principles. NVIDIA has been on an incredible run. Our stock has gone up more than 10 times in a few years. People ask me if I'm worried about a crash in AI stocks. The answer is yes and no. Yes, I think AI stocks, including NVIDIA, will be affected if there's a broad market crash. When panic hits, everything falls. Quality companies fall along with garbage. That's just how crashes work. But no, I'm not worried about NVIDIA's long-term future because our business fundamentals are sound. We have real revenue, real profits, real competitive advantages. We're not a speculative story. We're a real business solving real problems. The demand for AI computing is genuine. Thousands of companies need our GPUs to train and run AI models. Even if our stock falls 50% in a crash, the business will keep growing. And when the panic subsides and rational thinking returns, our stock price will reflect our business value. This is the advantage of owning quality assets. They survive crashes. Compare this to speculative AI startups with no revenue. Many of them will disappear in a crash. Their funding will dry up. They'll go bankrupt. Investors will lose everything. This is what happened to most dot-com companies. Only the real businesses survived. So when I think about the AI boom and potential crash, I separate the technology from the speculation. AI technology is real and transformative. It will change every industry over the next decade. That part isn't a bubble, but the speculation around AI stocks, that is a bubble. The valuations disconnected from fundamentals, the blind rush to invest in anything AI related, the certainty that AI stocks only go up, all of that is speculation, and speculation always ends badly. At NVIDIA, we're focused on the technology and the business, not the stock price. We're building products that customers need. We're solving real problems. We're generating real cash flow. That's what will carry us through any market crash. For individual investors, the lesson is the same. Focus on fundamentals. Own quality businesses. Avoid speculation. Reduce leverage. Think long term. These principles won't make you rich overnight, but they'll protect you during crashes and set you up for long-term success. One final thought. Market crashes are not just risks to avoid, they're also opportunities. The best investments I've ever made came during or shortly after crashes. In 2009, after the financial crisis, assets were on sale. Great companies were trading at tiny fractions of their value. If you had cash and courage, you could buy assets that would go up 10 times over the next decade. The same will be true after the next crash. Quality assets will be cheap. Great businesses will be trading at absurd valuations. Fear will dominate, and that fear will create opportunity for those who can think clearly. So yes, I believe a significant market crash is coming. The patterns are all there. The speculation, the regulatory shortcomings, the poorly understood innovations, the massive debt, all four patterns are present. History tells us how this ends, but I'm not afraid of it. I'm prepared for it. At NVIDIA, we have a strong balance sheet and a business that generates real value. Personally, I'm diversified, unleveraged, and maintaining cash for opportunities. I understand the patterns. I'm watching for the warning signs, And when the crash comes, I'll be ready. That's what I want you to take away from this. Market crashes are inevitable. They're part of the cycle, but they don't have to destroy you if you understand the patterns, if you prepare accordingly, if you can control your emotions. Crashes become opportunities rather than catastrophes. The course of history is changing. The AI revolution is real, but so is the speculation around it. The debt levels are unsustainable. The system is fragile. At some point, something will break. I don't know what the trigger will be or when it will happen, but I know the patterns, and the patterns tell me to be prepared.